U.S. banks are raking it in, JP Morgan is still on the hot seat, and one of our viewers is buying chicken. You're in the right place, folks, because this is where the money is. Howdy, folks. Welcome to the show. I'm Matt Koppenheffer, joined as always by David Hanson here. We've got a great show for you today on this wonderful Thursday. We're going to be playing a little bit of investing chicken today. We've got a closer look at the Canadian banks. But first, as always, we're going to start with the headlines. And David, this is some good news from the U.S. economy. The FT reports, the headline is U.S. growth revised upwards to 2.5%. The article reads, the U.S. economy grew by 2.5% in the second quarter at an annualized rate after a solid upward revision. The initial report was 1.7%. Hurrah! 2 thumbs up for the U.S. economy, right?
2.5% is the new 5%. That's what everyone is saying, 2.5%. Yeah, on the whole, not bad. Obviously, much better than 1.7, encouraging for the economy. Again, those numbers before, 1.7, not very impressive, but a lot of that was due to decreased government spending. The actual private sector part of the numbers looked good, and you continue to see them look good in this 2.5.
I think it's good. I like seeing the higher number. I think what still shines through here, consumer spending sluggish, business spending a little bit better, government spending down, holding everything back. That's still the story. Good that the numbers are up, but I still would like to see those core numbers moving in the right direction.
Moving on to the second one?
Yes,
Are you ready?
sir.
All right, moving on to the second one. We got it just from the AP here, and that's our own Fool.com format there. U.S. banks earned record $42.2 billion in the second quarter. That's impressive.
Billion. B. That's a big number. The second quarter, one of the big profit drivers in the second quarter that we saw were provisions moving down year over year. That's good. That's good because it's driven by lower charge-offs, it's improving housing market, improving balance sheet for the banks. But as we look forward, the delta that we'll see, the continued growth that we'll see, won't be quite as impressive because there's just not a lot of room for that to continue to move.
Yeah, absolutely. And you say the over $40 billion there. That's very impressive. That's for the whole banking sector. And I was wondering how much of this is just JP Morgan and Wells Fargo? It was almost 30%. It just shows you these two companies are, yes, JP Morgan's in the news, and we're going to talk about that in a minute, but these companies continue to post record profits. Very impressive, making up 30% of all banking profits, and that'll probably continue. And the big banks will continue to make up a larger share of that when you see a company like Citigroup and Bank of America, once they get through some of these problems that they've dealt with recently, they'll be up there raking in over $10 billion in profits. So
bold words.
That share is going to continue to grow.
Rounded out here, your friends over at JP Morgan. Bloomberg headline is JP Morgan bribe probe said to expand in Asia as spreadsheet is found. Imagine that, a spreadsheet at an investment bank. A probe of JP Morgan Chase & Co.'s hiring practices in China has uncovered red flags across Asia, including an internal spreadsheet that linked appointments to specific deals pursued by the bank. People with knowledge of the matter said. David, JP Morgan shareholder, does this make you want to sell?
I got to call my broker. No, I'm not selling on this news. This story sounds like it's something out of a movie, but this is not material to the business and my investment thesis in JP Morgan. It certainly sounds crazy. I mean, just conspiracy, spreadsheet, Chinese hiring. It's an interesting story, but no, this is not impacting my position on holding the stock at all.
Here's what I believe. I want to say here's what I know, and I think that this is probably going to be the case, but here's what I believe. This will get worse before it gets better in terms of how it looks for JP Morgan, how the media is looking at the bank and the company, how the regulators are looking at the company. We also have the Senate joining in on the probe into the energy trading. So it looks bad, and I think it may get worse. So I think investors who are in JP Morgan right now, which actually includes the both of us, have to have a pretty strong stomach.
Absolutely.
Moving on, the quarterly reports, the second quarter reports from U.S. banks are well in the history books at this point. But just this week, we started to hear the mid-year reports from the Canadian banks. And they looked good by and large. Pretty much all of them were topping analyst estimates. That's always good news. Investors are excited about that. But does that mean we should be fleeing the U.S. like scared children, running to our neighbors in the north and buying their bank stocks?
They should have good results. The way that these banks are valued, they're valued at a much higher multiple than their U.S. competitors down here. So when you look at, yes, they're performing well, the balance sheet looks good, they're posting record profits there. Yeah, they should be, because that's the stock price is expecting that right now. And going forward, I think there's a lot more optimism built into Canadian banks than U.S. banks. And in the long run, I don't know if there's that big of a difference in terms of the profit engines and how much they can return to shareholders. So to me, the businesses look like they're performing well, but from a stock perspective, I think U.S. banks still look more attractive.
Here's what is different about the Canadian banks versus the U.S. banks. That's that during 2008 and 2009, when U.S. banks were melting down and needed bailouts from the U.S. government, the Canadian banks did not. Made them look a lot safer. And that may be the case. They may be just better run banks. Certainly they managed through that crisis very well. Here's what's not different about Canadian banks versus U.S. banks. That's that the Canadian banking industry, and this is a structure of the banking industry kind of thing of Canada versus the U.S. There are fewer banks in Canada, and so at the top you have these very large banks that dominate the banking landscape.
Right.
In the U.S., it's similar that you have a handful of large U.S. banks that dominate the banking landscape. Over here we call them too big to fail. Over there they call it, that's banking.
The big five.
Yes. I'm concerned. I'm concerned about Canadian banking stocks. I think there was good reason for people to look at them and think that there was more safety in them following the crisis. Certainly if you were in them before the crisis and held throughout, you were sitting pretty.
Right.
But now I look at it, and Heather, let's throw up that first chart of home prices. So this is nationwide home prices adjusted for inflation. The U.S. is in blue, Canada's in the red. As you can see, a giant drop-off for U.S. home prices after the housing meltdown and financial crisis. Canada, meanwhile, housing prices have continued to climb. Now, you might look at this and say, hey, in isolation, that doesn't necessarily mean a whole lot. But I've got another chart here. And by the way, both of these charts come courtesy of our colleague Morgan Housel. He did a bunch of research, the FHFA, a bunch of the regulatory institutions in Canada to pull up all this data. This is housing price to rent ratio. So when we think about the valuation of a home, we can think about it in terms of the price versus what you could pay to rent it. So if that ratio gets out of whack, then we could say that housing prices are overvalued. So you saw both of these climbing through the first part of the 2000s, and then you see a divergence there. When the U.S. housing market melted down, the ratio fell drastically for the U.S. Meanwhile, just like housing prices, Canada's ratio continued to climb. So that makes me a little bit concerned about the Canadian housing market and about what the future holds for that market. And of course, that's going to impact the banks.
Right.
Meanwhile, just as the ingredients for a banking crisis here in the U.S. were an overheated housing market plus over-leveraged banks, the Canadian banks are very leveraged. So finally, I've got a table here of some of the Canadian banks versus some of the U.S. banks. This is looking at total assets divided by shareholders' equity. And as you can see, the Canadian banks...
Basically just a rough leverage.
Yes, there. This is a very rough measure of leverage. As you can see on the left-hand side, you've got some of the major Canadian banks. We're looking at 20 times, almost 25 times for CIBC versus the U.S. banks. Now, of course, this is after lessons learned from the housing crisis, but those leverage ratios, the assets to equity, much, much lower.
Right.
So, do I think that there is going to be some sort of catastrophic meltdown in Canada and with Canadian banking stocks? I don't know that I'm willing to predict something like that. However, when I look at the valuations like you mentioned, when I look at the state of the Canadian housing market, and when I look at the leverage on Canadian banks, and I should definitely point out that one of the things that we look at when we look at measures of banking success is return on equity. And one of the key drivers of return on equity is leverage.
Right.
So these higher leveraged Canadian banks are going to show higher return on equity because of that leverage. So when I look at the leverage plus the valuation plus the state of the housing market, it makes me a little bit concerned. In contrast, when I look at the U.S. banks, lower valuations, lower leverage, and if anything, our housing market still has room to come back as opposed to move in the opposite direction. So if I'm looking at the two groups side by side today, I am much more inclined to be buying U.S. banks.
Right, and it really, the picture of Canadian banks right now, it really looks a little bit like American banks before the housing crisis. And it wasn't just that housing prices were overheated that we had the housing crisis. Yes, that was a factor, but it also took some catalyst to get there in terms of the Lehman Brothers bankruptcy. So kind of the turmoil in addition to the housing market. So yes, like you said, there could be a crisis perhaps, but there perhaps needs to be a catalyst to go with it as well. But just, I'm on the same page with you in terms of looking at the opportunity. When you're talking about investing in banks or just any stock there, it's all about relative value and long-term potential there. I think it's glaring that U.S. banks have a little bit more long-term potential than where Canadian bank stocks sit right now.
Going from Canadian banks to a little bit of investing chicken, the insurer Markel, it's a foolish favorite, a specialty insurer, very well-run company. And today, David, you are on the hot seat. We're going to say you own Markel. Do you actually own Markel?
I do.
You do own Markel, even better. You own Markel. I'm going to give you some scenarios. You tell me at what point you are sweating so profusely and just feeling it in your gut that you have to sell the stock.
Now, are these stacked on top of each other, or are these just one-off events?
These are individual, but if I feel like stacking some of them, you know what,
you have
David?
The authority to do that?
I will. I will. I'm running this game, and I'll tell you if I'm going to stack. Number one, Markel recently acquired the reinsurer Alterra. Let's say that Markel takes big write-downs from that acquisition. Are you selling?
So write-downs related to business that Alterra has written in the past? No, I would not be selling, but that is a concern for investors. And when you saw the acquisition of Alterra, the stock took a big hit with that. And the long-term concern is that Markel has a very disciplined underwriting philosophy with their insurance group there. And the question is, can they bring that philosophy to Alterra? Because it was a big acquisition. It wasn't some small shop that they picked up. This was a large-scale acquisition that's really overhauling the company. So it would give me a little bit of a pause because that philosophy is very important to the thesis of Markel. I wouldn't be selling there, but that would be certainly something to look forward to in the future if that continues to happen.
All right, catastrophe hits. Never like to see that happen, but that is a big concern for insurers. We have a big catastrophe. Markel experiences larger than expected losses.
Larger than expected losses. Well, considering the nature of their business in terms of the specialty types of insurance that they provide, I'm trying to think of a catastrophe that would perhaps really knock them out because they're in so many different interesting niches. When you look at summer camps, yoga studios, I think last time we were talking about Markel, you mentioned antique cars. So they're in a lot of different areas there. This is insurance. Catastrophes happen. We were talking about AIG last time we were playing Investing Chicken. When you were on the hot seat, and you said, look, insurance, that's the business. That's why people have insurance, to protect against catastrophes. Insurers can take big losses. That happens. But Markel has such a good history of reserving enough to cover those losses. I wouldn't be too concerned. All
right. Moving on to number three, the stock. So as opposed to the company, the stock trades up to 3 times its tangible book value. For comparison, currently it is trading at 1.5 times its tangible book value.
That would be rich. When you think about a good
hitting home, I'm getting there.
When you think about a good insurer, 3 times they could be a great insurer, but 3 times is quite pricey. I think I could certainly say, unless we really saw outstanding results, outstanding returns, and compounding book value at that time, I certainly would not be adding to my position at 3 times book value, given what the business is doing now, if all things were equal. Not selling, because I still think they can compound that book value over time, but certainly not adding to my position there.
All right, we'll keep going. Markel makes another major acquisition, another Alterra-sized acquisition right now, right on the heels of that acquisition.
No, that would not bother me at all. I would almost be in favor of that. When you think about just getting more expertise, getting more things under their umbrella, whether it's an acquisition of another insurer, whether it's through Markel Ventures, which is their kind of new side business in terms of acquiring businesses outright, a little bit similar to Berkshire Hathaway in terms of getting actual businesses under their portfolio. No, I would be encouraged by that, not selling at that.
Are you trying to look at my notes? I've got two. I've got two more. Two more, and I feel like I'm going to take you down on these. The next one, I'm glad you mentioned Markel Ventures. The next one is one of the Markel Ventures companies fails outright. There aren't very many of them. This is a young arm. one of them fails outright.
Like you said, it's a young arm, it's a small arm. It would be a hit, but right now that wouldn't be enough to really hurt book value for me in the long term. So
It wouldn't make you concerned about the future of Markel Ventures?
Depending on the reason of why it would fail, too, that you have to consider that. If it was a prudent decision to buy the company or invest in the company, and I could be on board with that, and it failed for an external reason that no one could really see happening, I wouldn't be bothered with it.
Okay.
I know what the last one's going to be.
Last one.
Nervous.
Tom Gaynor, CIO, president of the company, and one of the most revered value investors of today's time. He leaves the company under mysterious circumstances. Doesn't even say why. He's gone.
Okay. If we're talking about selling, I would probably consider selling some of my position in that scenario there. When we're talking about growing the book value over time, that's really the value proposition if you're investing in Markel today, that you see that book value, you believe in the insurance operations, and you believe in Tom Gaynor and his investment team.
Okay, I'm going to cut you off right there.
He's cutting me off.
Let's say Tom Gaynor leaves, and you've got that 3 times tangible book value valuation. Have I knocked you out yet?
I think you would knock me out there. His track record of investing the capital of Markel and compounding that over time, it's very focused on equities. And over time, he's beat the market by several points, which it doesn't sound that impressive just saying that by 2-3 points over time. But again, over time, that makes a big, big difference in terms of growing that book value. So if they replaced him and someone couldn't do that and lags the market or moves to a more only fixed income type investing philosophy, if that was their cup of tea, I would not be as excited in Markel. Yes, they're a great insurer, but at 3 times book value, I think you could find opportunities elsewhere.
Glad I found some way to knock you out there.
I'm off the horse.
Let's finish up, as we always do, on the Twitter sphere. David, start us off.
Back on Twitter. Okay, let's throw the first tweet up there on the board from Todd Sullivan, at Todd Sullivan. Men who can be right and sit tight are uncommon. I found it one of the hardest things to learn. So I thought this was an interesting quote there. It reminded me of if you buy a stock, you find it undervalued, and you hold it, it doesn't do anything for a year, it's still undervalued in your opinion. It can be hard to keep with that philosophy and say, I still believe in this business. Is there a stock out there right now that you think is undervalued that hasn't really done much recently, but you're still holding tight with it?
The done much part of it is a difficult thing for me to think of because I don't watch my portfolio in that way. So I'm not looking at stocks and how much they're moving. But one of the things that quote reminds me of, or that tweet reminds me of, is the Wall Street phrase "dead money." And I heard it from Dick Bove, the bank analyst, the other day, talking about J.P. Morgan. He was talking about J.P. Morgan potentially being dead money for a while this regulatory overhang happens. I'm not worried about dead money. I'm thinking in terms of 5 years, not 6 months. So I'm looking at the business, I'm looking at today's valuation, I'm thinking about where that business can be and what that business is worth 5 to 10 years down the road. So I'm not worried about dead money. I want to own a good business, and I'm ready to sit tight and wait for the market to catch up, and in the meantime, have all those earnings compound.
Absolutely.
Moving on to the second tweet, we've got Michelle Coffey, that's at M_COF. Michelle writes, Cisco predicts that by 2020 there will be 50 billion devices, from toasters to watches, connected to the internet. David, does that mean you are going to be doing your banking from your toaster?
Maybe. You never know. It could be convenient, making your toast and deposit a check. This stood out to me because I wanted to get your take on it in terms of when we just think about the traditional banks, so retail banks, do you see the internet for a bank like Bank of America more as an opportunity or more of a threat to their retail business there?
I think that I think there's a little bit of both. So we see
You got to pick one. Which one does it lean more to?
I think it leans more toward opportunity.
Okay.
Because I think the brand that Bank of America has is going to carry over onto its internet presence. If we think about another industry like retail, Walmart, well, actually, this might undercut my point here. Walmart has its own online operations, but it's been upended by internet upstarts like Amazon. So tough to call Amazon an upstart at this point, but Amazon is really clobbering Walmart and other retailers on the online presence.
Right.
But Bank of America and the other banks, I think it helps them that they have more resources to be able to attack the opportunity that's available on the internet. And a big part of that opportunity is cost savings. Branch banking is very expensive for the banks. There still needs to be an aspect of that in banking, but customers like the convenience of doing it on their computer, on their mobile devices. It's cheaper for the bank. I think it's a good thing. I think big picture, it's more of an opportunity than a threat.
I think I agree with you, because when you think about, okay, anyone can go start an online bank. That's easy. That could be the initial thought. But like you said, the banks have
Are you starting an online bank?
Maybe.
Is there something I don't know here?
But if you think about the banks who have the resources to go out and invest in the technology, and invest in the infrastructure that's needed to do all this, those are the banks that are thriving today. The Bank of America, the JP Morgans, the Wells Fargo, they have the capital to go out there and invest in these operations. So on the face of it, it would seem like it's an industry that's ripe for disruption in terms of little guys coming in there and taking share. But I do think it's a threat, but still more of an opportunity for the big guys out there.
Okay, finish us off here.
Last tweet we have for the day, number 3, if we can throw it up there on the screen. It's from us. That's our Twitter handle, @TMF Financials. And we tweeted this out yesterday with the question, how would you fool in the blank? Blank is a stock I could buy today and sleep well if the market shut down for 5 years. And we addressed this on the show the other day, and you said JP Morgan, I said Visa. And we had a great response from one of our followers out there on Twitter, and their response was chicken. from John O. Greenwood, @JohnOG1982. Are you buying chicken for the next 5 years? I don't think you are, because you're vegetarian.
I am a vegetarian. I might buy a chicken to have at my house and take care of it, and I do eat eggs occasionally. But chicken is an interesting answer. If the stock market closed down, you would not have to worry about chicken.
One food that you would buy to hold for the next 5 years. If you had to buy one food to eat for the next 5 years, what is it?
Does it stay fresh, or do I have to think spam here?
No, it's like a perpetuity of food coming in.
One food. Can it be pizza?
It can be pizza.
I'm gonna go pizza.
I don't know. I asked you the question. I don't even have an answer for myself.
That's terrible.
Let's say
I'm answering spam for you then.
Let's say pineapple. I'm a big pineapple fan. Let's go with the pineapple.
That's a terrible answer.
Pineapple on your pizza, I'll just have the pineapple.
All right, folks, thanks for tuning in. Again, I'm Matt Koppenheffer here with David, the Pineapple Hansen. Thanks for watching. We'll see you next week.